Next was regulation and supervision. The regulation and supervision for these products, once they became legal in the year 2000, the extremely complex derivatives became legal in the year 2000, was minor, and part of it was voluntary. We're going to discuss that. The failure of company risk management practices. Risk management is a particular field of business specialization, and a lot of MBAs have studied risk management nowadays. It's an established field, but it's still in its infancy. It's only a couple of decades old. There aren't people from the Depression or World War II who are still active in business and can talk about really high-risk environments. It's grown up on its own as sort of an academic backwater, something used by large organizations, and it has attained a position where it is the management and it is the assayer of risk within an organization. And it's not going to say that the risks are too high if the instruments are making money. And it didn't do that. The impact of mark-to-market. Now, this is a particularly arcane, overly technical field, so I'm going to say this as simply and as quickly as I can. In the accounting profession, there's a principle called conservatism. It doesn't have anything to do with being politically conservative. It has everything to do with being economically conservative. It says when you think something is going to lose money or become valueless, you write it down now during the present economic period during which its loss of value is recognized. If you think something is going to make money, it's a good investment, it's a contract that's going to reward you exhaustively in the future, you only write up and only recognize the appropriate revenue for the current period. You don't bet that it's going to make more money later for you. You're conservative about making money and conservative about recognizing your losses early. This would mean that these derivative instruments that I've been talking about for the last few minutes would be marked to market. How much could you sell them for? How much would somebody else buy them from you today? How much would somebody buy them from you on the last day of your annual financial statement? That would be marking the derivative instrument to market. Now, a lot of these instruments, and there are millions of them now, are traded over Bloomberg machines by corporations. There is no market. They don't know who the other traders are. There's no record keeping. It's not done on the Chicago Board Options Exchange in Chicago, Illinois, with all its regulation and its registered brokers and its reserve requirements. None of that exists. Therefore, what is the market value? A certified public accountant who has been in practice for a long time is going to say $0 because there is no established market. You can't prove that a market exists and that a value exists and which this could be traded on the balance sheet date, and therefore you've got to mark it down. You've got to mark it all the way down to 0. This mark-to-market rule was suspended. FASB 157, scheduled to go into effect on November 15th, 2008, never went into effect because the Securities and Exchange Commission stopped it from being implemented. Therefore, the accounting profession was made part of a political agenda not to disturb the derivative situation, which is very unprofessional. Lessons from studying the origins of the crisis, references about the authors. You had basically a financial crisis around the subject of mortgage debt, and that crisis is continuing. There are ramifications throughout the world, but there's a way of government steadying and guarantee through the Federal Reserve Board and through the Treasury Department that will bring about a recovery, and in fact, things seem to have bottomed out and slowly be getting better. So we will weather this storm with the wisdom of our PhD economists in Washington, D.C., and we'll get through it and things are going to be fine. That is the standard presentation of this discussion by our government and by our media here in the United States. That is not what I found in my desk audit, howsoever. I have a timeline for this crisis. The timeline starts with 1973 and it goes up to the present day. And I want to go through this with you because it will make the conclusions that I draw very sensible. And the reason why I gave you the standard analysis first is that that represents about 35% of the notational value of the derivatives. There's another 65% out there that wasn't discussed and isn't discussed on television, and Brookings didn't look at it, and former Treasury Secretary Paulson ignored the question of derivatives when he was questioned about it when he was in office last fall, in the fall of 2008. Charlie Rose asked him about it, and he skipped right over the question and didn't want to discuss it with us. But the timeline says that this is a snowball that has been building for 35 years. First, in 1973, Fisher Black, Robert Merton, and Myron Scholler developed a formula which sets a price on an option. This is a mathematical formula that you can use to value options. For much of this discussion, I'm going to reference a book that came out late in 2007, just before everything went sour. It's written by Richard Bookstaber, and it's called A Demon of Our Own Design. John Wiley and Sons published it late in 2007. He says, no formula in economics has had as much impact on the world of finance. Merton and Scholes both received the Nobel Prize for it, readily embraced by the academic community, adopted from the mathematics of heat transfer differential equations of physics, and employing the new tools of stochastic calculus. 1973, same year, the Chicago Board Options Exchange opens. Now, the derivatives that were talked about in these early days were commodities futures. And this was true for a very long time. Two UC Berkeley finance professors, Hayne Leyland and Mark Rubenstein, according to Bookstaber in his book, developed the formula for portfolio insurance. They founded a management company. Portfolio insurance allowed a money manager to lock in gains without giving up continued appreciation. Bookstaber himself, working at Morgan Stanley in the 80s, worked out intentionally at the same time at the same gym that Barton Briggs did. Briggs was running Morgan Stanley Asset Management at the time and finally bit on the suggestion. Bookstaber then gave presentations and in less than a year had more than $3 billion in assets to hedge. A lot of money in those days. So Bookstaber was in on the boom days of the early derivatives and knew what he was talking about. He knew all the players. Rather than buying an existing security, portfolio insurance was ushering in the brave new world of synthetic instruments, financial instruments created on the fly using dynamic trading strategies. Portfolio insurance was not really insurance, but dynamic hedging, creating insurance-like protection. It assumes, portfolio insurance assumes, that prices will move without sudden gaps and that the market must be liquid. Prices will move without sudden gaps and the market must be liquid. We have already discovered 35 years later, 25 years later, what the Securities and Exchange Commission did when it found the mark-to-market rule would have required those derivative instruments to be written down to zero or near zero because prices were moving with sudden gaps and the market was not liquid. Those are the assumptions behind portfolio insurance. The snowball at the top of the 1987 crash was risk arbitrage. Most prominently, the risk arbitrage by Ivan Boesky and Robert Rubin. So, in October 19th, 1987, the stock market loses 22% of its value in one day. How did this all happen? It happened because on Monday, this was the Monday before the crash, the portfolio insurers were flooding the futures market in Chicago before the stock market opened. When the stock market opened in New York, stocks never caught up with the futures selling, and they can't be shorted except on an uptick, so the tidal wave engulfed the stock market.